Hey everybody, back with another video, and today we're going to be doing an update on Smith Wesson because they just had earnings, and to say that they were good would be one hell of an understatement. So first, let's go and actually look at those earnings. Starting with the EPS, they did $1.57 a share compared to a consensus estimate of $1.26 per share. That really doesn't matter to me. What the analysts think means nothing. They don't really know anything. But what's really important is that that was more than 50% more than what they did a year ago. That's amazing year-over-year growth for a company that's this old, that's this mature, that's this well established. Going down to the revenue, they did $274 million versus an estimate of about $278 million, I believe is what it was. Again, don't care about what the estimates were. And their revenues a year ago were almost exactly the same. They were just below that. What's particularly interesting here is that earnings went up while revenue went down, meaning that their profit margin increased substantially. And if we actually go and look at that profit margin, we can see that it was 22.8% for the trailing 12 months. However, for this quarter, they did 47%. 47% for a profit margin is amazing regardless of the company you're in, especially for something that produces hard finished goods like firearms. A 47% margin is something you would expect to see from something like a software company, a company that has very little costs after just the beginning. Next, we can go take a peek at free cash flow. And for that, I want to find the exact words that they said because it was pretty amazing. Here we go. During the first quarter, they generated $109 million of cash from operations, spending only about $6 million on capital equipment, meaning they had about $100 million in free cash flow. I want you to stop and think about that for a second. This is a company that is currently market capped at about $1.25 billion, a little bit lower today because of the price drop. That means that they are doing about 10%, just under 10%, of their market cap in free cash flow per quarter. If we actually go back and look over the past few quarters, we can see that in the last quarter they did 115, while the few quarters before that, a little bit lower. But still, the fact that they're able to produce that much in a single quarter for a company of their size, a small cap like this, is, the word astounding just doesn't do it justice. Going into that free cash flow a little more, Smith & Wesson's cash flow obligations, their share repurchases, their dividends, what they're going to buy, are extremely low. Remember that they did $100 million in free cash flow, while for the year at their current dividend rate, which is about 1.3%, paying 8 cents per share, they have about $17 million in dividend obligations, meaning that just with this quarter's free cash flow, if they broke even for the rest of the year, they would be able to pay their dividend multiple times over. Combined with their $50 million share repurchase that still hasn't gone through, that they would still be able to pay their dividend multiple times, repurchase the shares that they say they're going to repurchase, and have cash left over just from the first fiscal quarter of the year. Keep that in mind. That is amazing, especially for a company of this size. Stepping away from the quantitative and going into the qualitative, we can see that they have a few new products on the market. For example, they just launched their first shotgun, or I should say first shotgun in recent times, that did extremely well on its launch, and they have more products coming. So if you're a person who thinks, oh, well, this company just has what they have, there's nothing new, that's not how it is. They have new products coming out that are going to drive margins up, that are going to drive revenues up, they're going to keep the numbers that we're seeing going if everything holds that we think is going to happen. Even if there is no growth from here, even if you think this is a normalization, if this $100 million a quarter is what they're going to do, this company is still ridiculously undervalued. This big price drop that we're seeing today at around 8% is being fueled mostly by, as we can see here, a price target cut from $28, which is a laughable price target to begin with, down to $24 at Wedbush. Now, I want you to really think about this. I want you to take everything you know about value investing, everything you know about investing in general. It's currently trading at about $24. If you remove what it's down today, it's trading at $24 almost exactly. That means that these analysts think that a company which has a PE ratio under 5, a price to free cash flow under 4, essentially zero bank debt, almost no debt at all, generates about 10% of its market cap as free cash flow in a quarter, is fairly valued. If that doesn't tell you that analysts are useless and don't know anything, I really don't know what will. That is a laughable, a financial misfire if I've ever seen one. To say that this company is fairly valued given the metrics, given the financials, given what we've gone over, is laughable is the only word that I can think of. But let's look forward and see what things they can do in the future to see if they can sustain this level, if it's going to fall off, what things they can do. As we said, they made about $100 million in free cash flow for the quarter. If I was to make an estimate based on last year's number, which was, if we go to the trailing 12 months, about $300 million. I think that number is very reasonable to do again this year. I'd actually expect it to be a little bit more than that, but I would say between $250 million and $300 million in free cash flow for the year is very reasonable. I don't think that's crazy at all. So what are they going to be able to do with that free cash flow? What kind of things? How are they going to grow the value of the company? As I've said, they have the $50 million share repurchase program that still hasn't gone through yet, so they're going to do that. However, they cannot repurchase any more shares beyond that until 2023, I believe, because of legal agreements from the spinoff that occurred in 2020. So there will be no more share repurchases until 2023. And personally, I'm fine with that. They only have about 48 million shares outstanding. And back in the last earnings, when they really got a lot of volume, they were trading 10 to 12 million shares per day. That means that in theory, about a quarter to 20% of the company was changing hands day to day. That's a lot of volatility for such a small company, for such a mature company. I don't really want to see that. I think the current number of shares they have outstanding, maybe a little less. If they got down to 40 million, I wouldn't care that much. But if it got below that, I'd start to get concerned about liquidity issues and the ability to actually trade the ticker. So moving beyond share repurchases, let's look at ways that they can expand, ways that they can grow. Again, with about 250 million, that's going to take out about 50 million for, on the low end, take out about 50 million for the share repurchase, and then about 20 million for the dividend. That leaves us with about $180 million on the low end of our estimate. What are they going to be able to do? They have two choices. They can either make some acquisitions or they can try to expand their production capacity. Acquisitions will be difficult because there just aren't very many acquisition targets in their market. They're not going to go for another gun maker. That's just unrealistic. What they could look for is a company that produces accessories or that produces ammunition or something like that. For example, if there was a company of a micro cap, something that's valued in the double-digit millions that makes optics or things of that nature, they could look to get into that and maybe just have their own optics department, something like that. Other kinds of accessories, something like that would make sense. I'm not sure if they're actually going to look for something like that. It's something that's definitely on the table as a possibility, but I don't know if I would call it likely. What is much more likely, and what I know a lot of you are going to be concerned about, is the dividend. Granted, they only started their dividend less than a year ago, technically, at 5 cents a share, which was increased to 8 cents a share. This is going to have to increase over time if they maintain these levels of free cash flow. Investors are going to want to get some return on their investment, and dividends are the simplest way to do that. There are two ways that this can occur, three ways if you kind of say that the two ways can be combined. They can either raise the dividend, they can issue a special dividend, or they can do both. I would lean toward both happening as the most likely occurrence. I assume very, very heavily that this dividend will increase in the next 3 quarters by the end of the fiscal year, quarter 4, 2022 fiscal year for them. By how much is the real question. I would like to see it go from 8 cents to somewhere between 12 and 15 cents. A 50 to 100% raise would make sense. Again, their obligations are only $17 million in dividends, which is a drop in the bucket of their free cash flow. Even if they doubled it, they would still have more than enough money to pay it off. I don't want to see them do more than double it, just because when you do raise it by a certain amount, a lot of your investors get the expectation that you need to raise it by at least that amount the next time. If they were to say raise it by 20%, 20 cents this year, and then only raise it by 2 or 3 cents the next year, you're going to get a lot of investors who are just focused on the number and not the quality behind it to get a little antsy, might cause sell-offs, might cause issues in the investing community. So an increase of somewhere between 4 and 8 cents would be really nice, really like to see that. And then I'd like to see them do a special dividend. If they do make, $300 million in free cash flow, and let's say they end up paying out 30 to 35 million in dividends, plus the 50 million in share repurchase, plus let's say they spend another 20, 30 million on growth. Maybe they're buying a new factory, buying a new warehouse, buying production lines, stuff like that. That would still leave them with somewhere between 150 and 200 million dollars in free cash flow. I'd like to see them give about somewhere between 25 and 33% of that back to investors. If they were to just come out with a special dividend of $1, of 75 cents, something like that, I think that would do very well for them. I think that would be a good way to reward investors, a good way to get that money back into their hands as a reward for being loyal to the company, especially through these very stupid valuations. So just going over it in general, if you are a value investor, particularly a small cap value investor, you're not really looking for large caps because everyone's looking for large caps, or if you're a quality dividend investor, I really don't know why you wouldn't own this stock. I can really only think of two reasons. A, you don't actually know what value or dividend quality is, which if that's the case is fine. You should watch all of my videos and you will be more versed in that. Or you're one of those people who thinks that, well, I don't want to invest in guns because, I don't like guns and people shouldn't have guns. If that's the case, you're a communist and a piece of trash. But I repeat myself, please unsub from my channel. I don't want you here. The gun industry is not going away. There is no public support for gun laws right now, for gun restrictions with what happened in 2020. It's just not going to happen. It's a losing issue. Gun legislation is not a thing that is going to occur at a national level at any time soon. People want to own firearms. They want to protect themselves. People who used to not want to own firearms bought firearms in 2020. Now, does that mean that there was a peak in firearm sales? Maybe to probably. I don't think that they're going to do much better from here, but I also don't see them doing much worse from here. You have to remember that the people who didn't want firearms bought firearms, and people who buy firearms often buy a second firearm. It's something like 40 to 50% of people who own a firearm eventually buy a second firearm. Then you have to think about all the gun enthusiasts who like tricking out their guns, which again would make something like purchasing an accessories company, an optics company, a company that makes things like that a good idea. It could be a way to drive up that revenue. But beyond that, again, I'm probably the most bullish person on Smith Wesson in the world. I do not think there is a more undervalued company currently, especially one of this size, of this maturity, of this brand name. This is about as good a value as you can get. I don't like to put price targets on things because people always get angry when they don't reach them or whatever. But if you want to talk to me more in the Discord, I'll tell you all about what I think about what the price might be. But anyway, I hope this helps, and thanks for watching.